Let's drill down on what is causing the wild swings in the market. Kevin Caron is Senior Portfolio Manager at Washington Crossing Advisors. How do you explain today, Kevin? I guess a lot of the conventional wisdom is that part of it is that there is now seemingly some congressional money coming into the fray here with respect to coronavirus. But you can't sweat out completely Biden's big night, can you?
No, you can't. When you look at what has happened inside all of this volatility in the market, you've got some significant churn inside the market. So look at what performed the best. It was healthcare, and there's an obvious connection with the improvement in the prospects for a Biden candidacy. Then beyond that, you see safe things like consumer staples and utilities. So investors are still looking for that safety play. And then when you go down to the bottom of the list of the sectors that performed, let's say the worst today, it was energy, big connection to global growth prospects and commodity prices still at risk. And then you also have financials where you have more leverage there and some concern about loan growth. So there's still a lot of churn within this very volatile market. And we probably have some more of this chop to go before we're out of the woods. Let's
bring in Gina Sanchez, CEO of Chantico Global. Gina, welcome. Good to have you with us. You say the markets remain schizophrenic. I suspect that you're pointing to some of the same things that Kevin just mentioned, the wide dispersion in the groups that did well, like healthcare today, and the groups that basically stunk up the joint, like energy.
That's right. And also, if you look at actually just within the group of what did well, there isn't one clear theme. It's not as though you have a very, very defensive theme. You could say that if it was just utilities and healthcare, but you also have tech bouncing. You also have staples bouncing. Both of those are fairly, exposed to this, to sort of what's happening within China. Now, you could argue that this is really the response, this is policy response, and this is the result of policy response. Either way, all of those issues are short-lived. And what we're telling our clients is that this is really, the pain that will be experienced because of coronavirus will be fairly short-lived. However, all of the trends that went into this turmoil will be the trends going out of this turmoil. And if you felt that the market was still extended and overpriced, well, technology is probably still overpriced. We think value is a better play right now than growth. We think that you should be underweight high yield. We think that quality is a better play. And so all of those trends remain in place regardless of what happens with the next 4 to 6 months.
Gina, am I not correct in saying high yield has held up really remarkably well considering everything?
Well, it's had its moments. I mean, it definitely had several down days, and it was sort of headed down. And its response today has been pretty tepid. So it's not as though high yield had a big bounce. I would actually say that the market still doesn't know where it's going. That's what's clear. The response in the market today and the response in the market over the last several days has been all over the place.
Right.
We don't really know what's happening, and we're still taking on new information.
Kevin, one question to you. In the last hour, Jim Cramer showed an obscure to me, but not to him, oscillator. I believe it was an S&P market oscillator that he says has on multiple occasions going back 20-some years, whether it's 2001 and 9/11, the recession in 2008, 2011, 2008, has been remarkably good at showing where stocks are ready to turn. And he points to right now and says it looks to him, based on this oscillator, that we're at potentially a turning point. Do you think so?
Yeah, and I assume it means a turning point up, I guess, or does it mean a turning point down? I didn't see the segment.
Turning point up.
A turning point up. Okay, well, you have to forgive me for my confusion there because there's been a lot of movement in either direction the last couple of days. What I would say is a fundamentally driven shop at Washington Crossing. Ultimately, you've got a market that actually is being fairly rational. The market has been presented with a health crisis that does threaten global growth if it gets out of control, and no one really knows the path of this. So the market has to be forgiven to some extent for trying to price in something that's very difficult to price in. So it's hard to tell based on a chart which way this goes. I think ultimately a growing global economy will take care of itself, but for the time being, it's going to be difficult.
Gina, 30 seconds. You say favor value. By some measures, energy would be a value. Is it, or is it just a dead zone?
I think energy is a falling knife right now. I mean, yes, it's a very cheap area, but quite frankly, no matter how this plays out, the outlook for energy doesn't get any better. And it certainly isn't going to get any better if we have a hit to growth and to hit to demand through China. And as it stands right now, there's not a whole lot that's going to support it. So there's really no great story. I think that's a falling knife you stay away from.